Robert, thank you very much, and thank you to everyone for joining online this afternoon. I very much appreciate the opportunity to talk about the Rights and Issues Investment Trust to you. So I suppose my plan for the next 30 minutes or so is to, well, in the broader sense, explain the proposition, why I think this is an attractive opportunity, I suppose in the jargon, in the sort of marketing spiel that we formulated, why we think Jupiter and the Rights and Issues Investment Trust is a winning combination. So just by way of background, Jupiter took on the management of this investment trust at the beginning of October in 2022. So we are still relatively new in the seat here. So plan really is to talk about the background of the trust, the broad shape of the trust, the changes that we've made over the course of our management to date, but also to give you a sense of the team that stands behind the trust, the process that we employ to manage the trust, and as Robert referenced, to think about the top-down environment as we perceive it, as we think it's relevant to the work we do, and then to talk about, I suppose, the portfolio implications of that view. How does the top-down environment inform the portfolio construction process? And I hope to bring that to life to you through a range of stock examples, which are positions that we have introduced over the course of the last 10 months or so since we've taken on the management of the portfolio. So I suppose just to kick off by giving you some of the, I suppose, some of the dry detail perhaps, but just the general shape of the trust. So NAV of the trust about 130 million, as is commonly the case at this point in time. The trust is trading at a discount to net asset value, so mid-teens discounts, and market cap obviously somewhat smaller than the NAV right now. What are we aiming to do? On the one hand, we're referenced against the FTSE All Share, but I think, frankly, that is a little bit of a legacy. It is the way in which the board has chosen to think about the task of outperforming the reference index. But in terms of our day-to-day work, we are very much focused on smaller companies, but smaller companies we define as anything outside of the FTSE 100. And I'll come in to talk about my perception of the opportunity set, the features of the pool that we're fishing in as well. So I suppose that is the broad shape of the trust. A quick word on the management team itself. So Matt Cable and I are the lead managers for this portfolio. I started my career in the UK small cap world in 1995. Actually started in the regions, started with a small engineering-focused sell-side brokerage called Albert E. Sharp back in the day, known as the Casanova of the North at the time. Moved to London in the early 2000s and have been a member of the Old Mutual smaller companies team, and then that changed name, passed through the Merian brand until 2020, when Merian itself was acquired by Jupiter. We joined Jupiter with me as a co-head of the mid and small cap desk there. My colleague Matt Cable, equally, I think, very experienced, around 15 years worth of experience. Prior to joining Jupiter, he'd been at M&G for a number of years as well. So I think real experience and strength in depth in terms of our management proposition, if you like. Thinking about, I suppose, the history of the trust in a little bit more detail, we think without doubt, really strong legacy, strong record of value creation in terms of the trust, and hopefully that's sort of fairly obvious from the chart on the page in front of you. The trust was, I think, founded originally in 1962, so very much a venerable institution in the UK mid and small cap space. For the last 39 years, Simon Knott has been managing the trust. Was very much operated on a self-managed basis from 1984 through to last year. So some, obviously clearly hugely strong track record of value creation. So annualized NAV return of over 12% over his tenure, and that compares to just over 5%, obviously, for the FTSE All Share. So I suppose in very broad terms, what we're trying to do here is keep the best of what we had. So a real sense of continuity in terms of a long-term mindset behind our investment approach. Very much trying to run the portfolio with a high conviction, concentrated approach as well. So we'll come to look at that in a bit more detail, but in brief, you should expect to see around between 20 and 30 holdings in the trust at any point in time. We want to make sure that whatever we're doing, every position ultimately counts. Important part of the legacy here. What else? Well, board oversight, extremely strong. I think, we've got a very experienced board that has been in situ for some time. And actually, Simon Knott, previous manager, is a member of the board as well. So he's there holding our feet to the fire. In fact, actually, I've just come from, a board meeting, on the trust today. What else? Discount control. So to the extent that the discount is greater than 10% versus NAV, then the trust does have the power to buy back shares, and it has been doing that consistently for a long period of time. But also low costs as well. So management fee, 60 basis points, but Jupiter has, if you like, guaranteed for the first 5 years after our appointment that fees will be capped at 80 basis points. But obviously, clearly, we want to bring evolution. We want to bring development to the trust as well. So we'll come to look at the investment capability, if you like. But Matt, Cable, and I are part of a wider team, so a 10-strong team of investment professionals looking at the UK mid and small cap space. We are supported, as you'd expect, by a fully fledged investment platform. We have started the process. In fact, I think we're well down the line of repositioning the trust, taking perhaps lower individual stock risk while still maintaining a real sense of conviction. And as I said before, positions that really count in terms of their weight in the portfolio, but in the context of introducing more balance both at a stock level and we think at a sector and thematic level too. So I suppose pulling some of those thoughts together, I won't go through this slide slavishly, but I suppose some of the interesting facets here, the structure of the trust, the fact that clearly by definition it's a closed-ended vehicle, does offer us, particularly in tandem with that longer-term mindset, the opportunity to invest in less liquid stocks, something that's more difficult to do in the open-ended world, where as a mid and small cap team we spend most of our time. Again, we intend to continue this high conviction, concentrated approach. We'll come on to talk about the investment process itself. I think that makes us somewhat different from some other small cap investors in particular. I'll go on to explain what I mean by that. But I do think, one of the real benefits of us taking on this, the management of this particular trust, is the fact that it does, I think, fit very neatly alongside what we have been doing for many years. We've got upwards of 2 decades worth of heritage in the Jupiter UK mid and small cap team of managing assets in this space, currently managing around 1.5 billion in the UK mid and small cap space. So just a very quick snapshot. I won't dwell on performance per se. I think, while it's difficult to sit here and say that the last year's numbers or the year from the start of September last year are necessarily exciting numbers, I think it is indicative of the fact that as a management team we've made a solid start here. And just to compare, if we look at the NAV return, down by just over 2% over the course of the last 12 months, or the 12 months to the end of August. But if indicatively I look at the wider open-ended small cap sphere, the median of the UK small cap peer group's down about 6%. So it does show it has been in the last couple of years or so, it's been a challenging environment, but I think therein lies perhaps the opportunity going forwards as well, which I'll go on to explain. So a very quick word on, if you like, the asset class itself and why I think this is such an interesting space. I could wax lyrical about the fact that over the long term, it's an environment that's constantly changing. By definition, ours is a world where we do, in inverted commas, normal times sort of see a lot of IPO activity, clearly for obvious reasons, given the degree of, I think, uncertainty and risk aversion around now. That's not been a feature over the last 2 or 3, 4 years. But what we still have, I think, is the idea, the essence of the opportunity being the fact that our world, I think, remains an under-researched part of the market. It is, I think, easier to add value as a non-insider in the mid and small cap world than it is further up the market cap spectrum, by virtue of the fact that our companies I think are relatively poorly covered. There are a few analysts typically covering stocks in our world, so it does offer the opportunity, I suppose, to become a better informed non-insider than other market participants can be. So our goal is very much, given the scale of our team, given the reach that I think we've developed over the course of a couple of decades, is to develop and sustain a research-driven advantage versus the competition. I mentioned earlier in this discussion, I thought that our process makes us a bit different from some other managers operating in the UK mid and small cap space. And really what I mean by that is the fact that we have this balance of top-down and bottom-up analysis. It's my perception that a lot of practitioners in the UK small cap space, at least, tend to be very much bottom-up led. We have always made the top-down, if you like, so the debate around the ideas you see set out on the right-hand side of that slide there, the outlook for economic growth, the interest rate cycle, what other extreme events might there be, war, clearly a topical issue right now given Russia's invasion of Ukraine. We've always made those dynamics the starting point of the portfolio construction process. So to that end, as a management team, we have a regular monthly debate involving all of our UK equities colleagues around those themes. And the purpose of that is not necessarily to come to a definitive answer as to all of those elements, but it really is a forum where we can, I suppose, broadly decide two things. Which sectors do we think are likely to perform better or worse, and why? And alongside that, should we expect particular themes, be it growth or value, to perform better or worse than each other? So we're trying to use that forum to answer those broad questions, if you like. And then we're backing that up on the left-hand side of that slide with what I think is, very detailed stock-specific work. I didn't mention it on the previous slide, but I think one of the key opportunities that we face, or we have in the small cap space, is the fact that we have great access to company management teams. So, it's my perception that further up the market cap spectrum, there's a real risk that when you meet with company management teams, there's a glitzy, stage-managed, prescriptive formula that they want to feed would-be investors with. In our world, it's a much more, I suppose, in inverted commas, real dynamic, i.e. we sit around the table, either literally or via Zoom, but, we are meeting very directly with company management teams, and we are conducting those meetings very much to our own formula, if you like. We are trying ex ante to try and understand what the key sensitivities in an investment case might be, and then probing around those. We think about the sorts of stocks that we are looking for over the long term, where we think the opportunities lie in our opportunity set. We're trying to identify stocks that exhibit at least one of three key attributes. So in the middle of the page there, do they offer the opportunity, or do they have the capability to deliver sustained above average earnings growth? Is there some dynamic, some sort of unique product or service that they have which should enable them over the long term to grow at a rate much faster than the market average, and in a way that's not particularly a function of the wider economic environment? So, are there structural growth facets to that particular investment case? We're trying also to find stocks which we think, ex ante, if you like, can deliver positive earnings surprise. So we spend a lot of time analysing what we think is a representative reflection of sell-side forecasts and trying to understand where those forecasts might simply be wrong. So trying to combine that sort of thinking with the meetings that we would have done with company management teams to understand, if you like, some of the sectoral market trends that those companies face, and then to try and relate those back to forecasts to understand where opportunities for outperformance might lie. And then thirdly, trying to find stocks which we think can be re-rated relative to the market. So I suppose to bring that sort of slide to a conclusion, what we're essentially trying to do is put ourselves in a position where we're happy with the stock-specific attributes of each individual holding, but when we look at the portfolio in aggregate, it's consistent with where we expect market leadership to lie. So I mentioned that I was going to touch on top-down thinking, if you like. So I suppose to try and distill that down into a slide and then relate that to what we're doing on the trust. Well, I suppose the first comment I make is that self-evidently we're in unusual times. We are coming out of a pandemic after a decade or more of extraordinary monetary stimulus taking place through quantitative easing. Interest rates are now normalising. But I think the central point that we make, or the central observation we make, is actually, notwithstanding all of those reasons to worry, the developed world, and certainly the US in particular, which tends to be the trend-setting economy, does seem, in terms of economic growth at least, to have held up far better than I think most commentators would have expected, if we were to go back a year or so. And within that, I think it's fair to say that, and that's certainly the case in the UK too, that labour markets have remained, frankly, remarkably strong. While unemployment has risen marginally, we are, essentially at around sort of 4% unemployment, not far off full employment. So the likelihood of a deep and lasting recession at a time when labour markets are as strong as they appear to be does seem to be somewhat reduced to me. Clearly, if we think about, I suppose the central debate in markets right now, it's all about inflation. That clearly, or the path of inflation, will dictate the extent to which central banks continue to tighten in response to that in an attempt to try and bring those forces under control. I think in terms of inflation, what we observe is that goods inflation does now seem to be cresting. I think more of a question mark against wages or wage inflation and services price inflation more generally. So, what we're not saying is that central banks have finished the tightening process. They clearly do have some more work to do, albeit it feels that we are now close to the peak of the interest rate cycle. But I think we would nonetheless expect that having, on both sides of the Atlantic, probably later this year, got to a peak in the interest rate cycle, probably as a central case at least, expect those rates to stay at levels similar to now for some time, certainly for a year or so. That's all very well, but what are the portfolio implications of that? What does that mean in terms of our positioning from a thematic perspective? And I suppose the points I'd make here, and particularly if I think about crudely the balance between the growth and the value theme that we think it's right to try and achieve in this environment. When we think about the interest rate environment, clearly, interest rates are materially higher than they were 2-3 years ago, and certainly materially higher than they were during much of the 20-teens, if I can call it that, when we had this, if you like, golden period for growth stocks, in a world of very low growth or lowish growth with ultra low interest rates, that was a perfect environment for significant multiple expansion. So P ratios rising very significantly in that environment. Those days clearly have gone. So we think about growth stocks, or stocks with structural growth attributes that trade at a premium to the market. I think the current environment is one where, to the extent that you've got those sorts of companies in the portfolio, you need to be very discriminating about valuation, and we'll come on to illustrate how we're thinking about that. We do have some growth stocks in the portfolio, some that we've introduced, but I do think there's a real lens on valuation when we do that. In terms of cheaper, more overtly economically sensitive stocks, well, I think this is an environment where, as we get towards the peak of the interest rate cycle, and I think over time, confidence grows that economic growth is broadly, on track, and we're certainly not destined to have a deep and prolonged recession. In that environment, certainly in our opportunity set, in my judgment, that's if you like, an environment where selectively we can expect certain well-managed, sensibly financed, economically sensitive stocks to re-rate, and we'll touch on some of those opportunities as well. I have a concern about overtly defensive stocks, because I think actually, given the uncertainty that we've seen across economies and markets generally, in my view, a lot of those sorts of names are quite fully valued relative both to their own history and the wider market right now. So I'm concerned that that's probably not the best place on a medium-term view to make absolute money, even if on a short-term view, it's the sort of place where you can hunker down and not necessarily incur a lot of earnings risk in the short term. But I'm not sure that that's the best place to be for positive returns on a medium-term view. I did want to touch on the opportunity in UK mid and small caps right now too. So the chart just looks at the 12-month forward PE across a range of different markets, going back to, on this one, June 2013. But I suppose the point I'm trying to make here is, if you look at, I think, around sort of 2015, 2016, there was a real bunching of the indices. There was no great difference between the 12-month forward valuation on, say, the US MSCI, or indeed the FTSE small and the FTSE mid caps at that point in time. Clearly, in 2016, we had the Brexit vote. We've had a number of years of political uncertainty that have followed. Those clearly, I think, have been unhelpful dynamics for the perception of the UK, and maybe related or maybe unrelated, but at the same time, I think we've seen a continuation from a UK perspective of, if you like, sort of structural disinvestment by UK pension funds and UK wealth managers in the UK equity market as well. So if you go back 20 years or so, not uncommon to have allocations to the UK of 40% plus. Over the course of the last 2 or 3 decades, that's gone down, I think, to about sort of 4 or 5% weightings to the UK. So we've seen the significant disinvestment from our space. But I'd like to think actually the stars are beginning to align to make things a bit more interesting for us. An end perhaps to political uncertainty. I think certainly an argument that says any Labour government, were it to form the next government, would actually adopt quite a technocratic stance to the economy, and therefore probably I think would be reasonably well received by markets. More latterly, we've seen, I think, more evidence both in terms of GDP growth and inflation that the UK is perhaps less of an outlier than it has been perceived to be as well. So my view would be that actually there are a range of reasons why the UK can begin to close the gap, if you like, the rating gap that currently persists versus the wider array of indices globally. Which brings me on to some of the stocks that we've introduced over the course of our tenure so far. So recall, I think my argument so far has been, on the one hand, there is a process which looks at both top-down and bottom-up, and for that reason, if we think about the top-down piece, it causes us, it makes us think about not just the individual stocks themselves, but perhaps some of the themes be it growth or value, that we are putting into the portfolio. On this particular slide, what we've got here is a range of growth stocks that we have introduced over the course of our tenure to date. So we'll just spend a few moments talking about some of those. All of the stocks you see on this particular slide represent about 5 to 6% of the portfolio right now. So Alpha Group, if I can start there, is I suppose in the wider sense a financial services business, but a very distinctive one in our view. So this is a business which provides FX, broking and advisory services for the small and mid-cap community, not just in the UK, but actually, increasingly around Europe, but also in Canada too. So a very, if you like, sort of front office marketing-led approach to expanding their proposition, but they've complemented that so-called FX risk management activity with a suite of technology-driven alternative banking services as well, particularly addressing the specialist funds world. So a space that, in our view, was very under serviced in the past. And I suppose the product of all of this is that we've got a business with really strong rates of earnings growth, but actually an exceptionally strong balance sheet as well. So by the end of this calendar year, we'd expect the business to have over 200 million, around 200 million pounds worth of net cash as well. So it does trade on a premium multiple, but achieving, we think, very, very strong growth. Second stock here, Gamma Communications. So what is it? It's a so-called cloud telephony business. So what's going on here is that traditional phone networks are being turned off. The whole industry is increasingly moving to what's called, internet protocol telephony, and Gamma are a real leader in this space. So a real sort of structural growth opportunity here. Again, very strong balance sheet. So by the end of this year, around 130, 140 million pounds of net cash. But a stock which, notwithstanding the fact it grows earnings at least, at low double-digit rates, trades on a P multiple of only about 14.5 times this year and about 13.5 next year if you look at consensual numbers. And then finally on this slide, Telecom Plus, a reseller of domestic energy and telephony services. Proposition here, essentially, we think that they can double their market share. So they've got about 900,000 customers in the UK now. Over the course of the next 3 to 5 years, I don't think it's unrealistic to expect them to double that number. And so EBITDA in this business is currently, or last seen March year end, probably about 110, 120 million. Over the course of the next 3 to 5 years, we think something like 300 million is possible with a degree of operational leverage coming through as well. I don't think I've got time to talk through every last stock in this array of new additions, but with an eye on the clock, I might just turn to Marshalls, because I think it's something at the other end of the spectrum, and I think it exemplifies what we've been trying to do in terms of utilising some of the opportunities that running a closed-ended structure gives. So I suppose by way of introduction, Marshalls, it sounds a little bit prosaic. Notwithstanding it's a market-leading business, what does it sell? It manufactures stone, blocks, concrete tiles, but as I say, a market leader in its space, a business which historically, in terms of earnings per share at least, has delivered upwards of 30 pence per share of earnings. Over the long term, it's a business which certainly has sustained in terms of a PE multiple, a mid-teens type multiple, now trades somewhere near a cyclical low on about 14, 15 times, share price of about £2.60 right now. Our view would be that over the course of the next few years, as markets gradually recover, so it serves both domestic markets, so people having driveways paved and the like. It also services the house building sector. They've got strong positions there. Clearly that market is, I think, somewhere close to a cyclical low now as well, and also a range of infrastructure markets as well. So over time, we'd expect conditions in those end markets to improve, and I don't think it's fanciful to think that they can at least get back to historic levels of profit over time. If they're to do that, I think rationally one could look for, over the course of the next 3 to 5 years, at least a doubling of the share price as they recover back to a historic multiple on on recovered profits too. So hopefully I've given you a sense at least of the line of thinking, some of the names that we've introduced to the portfolio and why. I suppose just to round that out before we move to questions, the chart just shows the evolution of the portfolio since we've taken it on. So if we look at the top part of the chart there, the bar chart, it shows the positions in the portfolio in terms of the weight. So the darker of the two sets of lines are the opening positions, and you'll see over time we've brought some of those very large positions down somewhat in, I think, in a controlled fashion, introduced a range of new positions too. While we've been doing that, the average market cap of the portfolio has come down somewhat. So I think we've remained very much true to the concept of being a out and out small cap product, while at the same time diversifying the portfolio somewhat, but very much retaining the sense of real conviction in terms of the positions that we have in the portfolio too. So I suppose to summarise then, obviously conscious of the legacy, the heritage that we have taken on in terms of becoming managers of this trust, bringing, in terms of the day-to-day work, we think a really compelling process which combines top-down and bottom-up thinking with, I suppose, the objective of delivering over time not only strong performance but consistent performance as well. But I think we've taken some really sort of positive, tangible steps in terms of introducing greater balance both at a stock level and a thematic and sector level, while retaining a real sense of conviction behind the way in which we run this portfolio. So, conscious that I think some questions have popped up on the screen there. Sorry, I haven't really had a chance to digest those yet, but I don't know whether any in particular can be picked out there, Robert.
Yeah, I mean, I think the last one to come through is often and you alluded to this earlier, I think this is often on people's minds. When you have a trust that is trading at a discount, what's the process? Do you have kind of goals in line to reduce that and the time frame? Yeah, I'm just conscious that someone's asked that, but I know it's something that will be on a lot of people's minds, understandably.
Yeah, and I completely understand the concern, the question. I mean, I think the reality is that clearly we've got, and we have had for a number of, in fact, before we took on the management of the trust, there were mechanisms in place which have been being used to try and control the extent of that discount. I suppose the frustration is that, notwithstanding the fact that those controls are being used and a buyback is in train from 1 month to the next, so around £1 million per month of stock can be bought back. We cannot directly control the extent of that discount. So I think candidly, it's up to us. It's up to us to deliver good numbers, consistent numbers, and I think to win over the market, if you like, to over time reduce the degree of that discount. I think it's fair to say that while the discount on the rights and issues trust is probably towards the wider end of the small companies spectrum right now, I think all trusts in the space are suffering to some extent from the same issue as well. So I don't think we are necessarily a material outlier in that sense. And I suppose, and I would say that, wouldn't I? To a certain extent, therein lies the opportunity, if we're right about being able to deliver decent performance over time, if I'm right about the fact that actually the wider space, by that I mean the wider mid and small cap space, which is currently trading at a, I think, unusually wide discount to international indices, if the reasons or the stars are beginning to align for that situation to reverse as well. I think that does make, in conjunction with the discount that we're currently seeing, that that makes the proposition ultimately much more compelling for the medium and long term.
Mm-hmm. And one thing that I was interested in, just very quickly, when you were talking about Marshalls, for example, at the end there, you spoke about it returning perhaps to its historic valuations. Of the companies within the trust, I mean, how many of them have sat on the FTSE or AIM for quite a long while? Or how many of them are new entrants? And I know we've had a squeeze on IPOs in the past year, but are you interested in these companies that are just coming to public markets? Do you have any of those in the trust?
Well, the short answer to that, Robert, is no, we don't. What to say about that? I mean, I think, as I touched on during the discussion itself, we're currently in a situation where there is, very limited, if frankly, sort of zero IPO activity. I think over the course of 2023 to date, there'd probably only been one or two IPOs of any consequence. So I suppose the message to would-be investors in this particular trust is, don't expect us to embark on a flurry of activity in the IPO space, even if we were to see those markets reopen. Because I think actually the opportunity set is already so sort of broad, so rich, and I think so full of ultimately mispriced stocks that we don't necessarily have in the context of this fund, where, candidly, we are trying to build a portfolio with, where every position counts. I think the IPO world is by definition a bit more risky. A lot of businesses are, in a market sense at least, somewhat unknown quantities. So moving to have, a 5% position in a newly sort of floated company is, I think, not the sort of thing that you'd typically expect us to do. So I don't think this is necessarily going to be the vehicle for that sort of that sort of stock. But I don't perceive that to be negative at all. I think at the current point in time, there's so much opportunity out there that we just don't need to play at that end of the risk spectrum.
And there's a question here which it assumes that you invest in AIM companies, which I believe you do as well. And they've said here something quite specific. Do you think that if inheritance tax were to be scrapped, it would have an impact on the AIM market, as those exemption benefits become obsolete? I mean, do we really think that's enough of a gravitational force to raise the value of the AIM market? Or?
Well, so I think certainly in recent days, there's been a degree of kite flying from governments across a range of themes, and the idea of abolishing or at least curtailing inheritance tax has been one of the ideas raised as we head towards an election. It is fair to say, if we look at the AIM market and who the holders or which entities currently hold, reasonable slugs of the AIM market, IHT funds are certainly, one of those stakeholders, if you like. So to the extent that, inheritance tax itself gets abolished, and I suppose by definition, the raison d'etre, the need for IHT funds disappears, then I think in the short term, at least, there might be a risk of disinvestment, or at least, maybe forced selling by funds that have invested on that basis. I suppose the flip side of that is, firstly, in that environment, you might see in the short term, at least, maybe some sort of disorderly action in some of those share prices. To the extent that you are really happy with the fundamentals of those businesses, that would be a great buying opportunity. So it wouldn't necessarily sort of spook me. And I suppose to extend that point a little bit more, I'd like to think that, we do some pretty exhaustive due diligence on the companies that we invest in. So I don't think that IHT benefits disappearing would undo the fundamentals of those businesses at all. So I think they would continue to trade in an operational sense very much as they had done before. So I suppose that's a long-winded way of saying I'm aware of the concern. I don't think it really sort of bothers me for the long term. I think it would just ultimately throw up a pretty compelling buying opportunity.